Yes, I am on a walking pad. If you buy in the wrong neighborhood, you're going to be fighting that property for years. If you buy in the right one, appreciation and rent growth, it's going to do half the work for you. Location still matters. The question is how to identify the areas that are about to move, not areas that have already moved. Hey, do me a favor, like the video, subscribe to the channel, hit that notification bell so you don't miss the next checklist for serious operators. If you're new to the channel, I'm Bud Evans. I'm a retired United States Air Force officer. I'm a retired police officer. I'm the former mayor of Cinnaminson, New Jersey, and I'm an active real estate investor in New Jersey, Pennsylvania, and Ohio. I now mentor veterans and first responders in real estate and founded a low-cost, investor-focused property management company in South Jersey. All right, let's get tactical. High-growth neighborhoods, it's not random. They leave clues. Your job is to read them before the price actually spikes. First, look for infrastructure changes and public money. Go to your zoning meeting. Government spending is a signal. Look for new highways, transit expansion, school upgrades, water and sewer improvements. If they start putting in redevelopment or enterprise zones, cities don't invest millions without expecting growth. When you see the infrastructure money start flowing, start watching the surrounding block. As a former mayor, I can tell you this. Development conversations happen years before the public notices any change. So pay attention to the council agendas and the planning board and zoning meetings. Next, watch job growth, not just population growth. Jobs are what really drives housing demand. So these are what you want to look for. Major employers moving in, larger companies, hospital expansions, distribution centers, talking to you, Amazon, university growth, military bases expanding. If stable jobs are increasing, rental demand will usually follow. No jobs, no growth. Guys, it's just that simple. Third, study price trends and look block by block. Don't rely on just citywide averages. Drill that stuff down. Are renovated homes selling faster or slower than new built? Are days on the market shrinking or expanding? Are price reductions decreasing? When properties start moving quickly at higher price points, guys, that's momentum. You want to enter when the curve is rising, not when it is at the peak. Fourth, track that rent growth and occupancy. Appreciation is nice, but cash flow is king, and it really keeps your business alive. If rents are climbing steadily and vacancy rates are really low, simply put, demand is strong. How do we find those numbers? If you're not good at doing this yourself, talk to property managers, call other landlord investors in the area. Look at how quickly listings are disappearing on Zillow or Redfin. Real-time rental demand tells you more than any headline you're going to look at. Look at the path of progress. And this is important. Growth usually spreads outward. It moves from high demand areas into adjacent neighborhoods that are still affordable. It's why I invest primarily in municipalities outside of metropolitan statistical areas. If a neighborhood next door has already appreciated heavily, look at the border area. Look at the next door neighbor. Look down the street. Are there new coffee shops opening? Are small multifamily properties being renovated? Are out-of-area investors starting to buy in these areas? That's the ripple effect. You throw the rock in the pond and you watch it. Sixth, observe retail and lifestyle shifts. Retail follows rooftops. So when you see new grocery stores popping up, national chains moving in, an increase in fitness centers or gyms, new restaurants, that signals confidence in consumer spending. Retail developers do serious market research. If they are entering the area, pay attention. Seventh, watch your crime trends carefully. As a former cop, I can tell you this. Safety perception drives value. Pull the crime data. Look at heat maps. Look for downward trends, not just current numbers. Is crime decreasing year over year? Is the city adding patrol resources? More law enforcement? Nuisance properties being cleaned up? Improving safety often precedes some price growth. Hey, drive around. Look at the neighborhood yourself. Data matters, but so does observation. If you're seeing homes that used to be boarded up and now they're being renovated, or lawns that are being maintained, and there are dumpsters in driveways from rehab projects, are contractors working on multiple houses? Physical signs of reinvestment matter here. If you see money flowing in, you're early or you're just on time. Ninth, understand school district shifts. Now, I know most people move to a new place because of work, not necessarily the school district, but the school districts that's popular in the area, they're the ones they're going to move into. So even if you're buying rentals, school ratings are going to influence that family demand and long-term appreciation on the property. If a district is improving, test scores are going up or building new facilities, that's a signal of growth. 10, avoid emotional hype. Don't buy because some agent said that the area is up and coming. This is math, not magic. So buy because the numbers are going to support it. And what are we looking at? Job growth, infrastructure investment, rental demand, declining vacancies, or increasing renovation activity. Growth is going to leave you a trail here. Okay, let me pause here for a second. If you're a veteran and you're trying to build wealth through disciplined real estate investing, this type of neighborhood analysis is exactly what we do, and we break it down inside the War Room with David Perret. We look at markets through an investor lens, not hype. And when it makes sense, if you're law enforcement or a first responder, I do offer one-off coaching calls. Go to buddevans.com. I'll help you analyze specific markets and stress test your assumptions before you deploy any capital. Both links are in the description. Now let's lock this in, as always, with a checklist that you can use. 1, follow infrastructure and public spending. 2, track that job growth and major employer movement. 3, analyze price trends at the neighborhood level. 4, monitor rent growth and vacancy rates. 5, identify the path of progress from high demand areas. 6, watch that retail and commercial development. 7, study the crime trends, look at it over the past, and look at what's projected in the future. 8, physically drive and look for reinvestment. 9, monitor the school district improvements. 10, base your decisions on data, not hype. Remember, it's math, not magic. Hey, look, don't just buy anywhere. Buy where the momentum is moving. If this helped you, do me a favor, like the video, subscribe to the channel, hit the notification bell, and share this with a friend if you have any. Thanks for watching. I'm Bud Evans. Aim high, execute fast. See you on the next one.